Hey fellow investors, my name is Maxim. This is my first YouTube video and for some reasons I decided to take really a serious topic for that. And the current market climate presents undeniable challenges, characterized by heightened volatility and uncertainty. And today we'll embark on a journey to eliminate the key macroeconomic indicators driving the market behavior. I'll share my thoughts on it, on geopolitical context, and of course the US national debt. Some disclaimer, everything you will hear today is not the financial advice. So, let's begin then. Imagine, if you will, the global economy as a complex ecosystem. It consists of a huge amount of processes and correlations. Let's check the macroeconomic indicators and let's see what we have there. It will be easier to visualize data. For today's video, I picked 3 of them: US national unemployment rate, capacity utilization rate, and industrial production. So, let's go with the first one. The US national unemployment rate. Currently, it's at its low level, around the same level we saw back in the beginning of 2020, third quarter of 2007, and in 2000. I believe you already know what I want to say. Yeah, right after these dates, we met a pretty tough financial crisis. Dot-coms, mortgage crisis, COVID. You may say, but hey, isn't low unemployment a good thing? Yeah, it is, in some perspective. You may not know, but unemployment and inflation typically did have inverse correlation, and the reason is the fundamental supply and demand ratio. With lower unemployment, companies have to raise wages to attract employees, which leads to wage inflation, and the inflation may lead to recession. But no panic. Economy is a cyclical instance. We saw these processes before and we'll see them later. So that was about the US national employment rate. What about the second indicator for today? Capacity utilization rate. It shows us the percentage of resources used by corporations and factories to produce goods in manufacturing, mining, and electric and gas utilities for all facilities located in the US. And what do we see here? Actually, we see now that the rate started to melt down from 81% to the lower values. When did we see something similar? Yeah, I bet you already know. Capacity utilization usually had been reducing right before the recession time periods. It's obvious that once there are too many manufactured goods, mined resources, the demand for them is reduced, which again leads to the price decline, manufacturer layoffs. At around that moment, people start to reduce their spendings, companies do the same, and we start to see early signs of recession. And in addition to that, the last indicator I would like to show today is the Industrial Production Index. Usually it's not really insightful as it has a long-term rising trend, but these days the index is struggling to break through 102-104 points. We already saw this value back in 2007-2008, and since then we have never gone upper. Usually declines in API correlate with recession periods. No doubt that one day the index will overcome 104 level, but considering previous indicators, I'm not sure now is the time for that. Well, we're done with macroeconomics. Let's move further. The geopolitical landscape presents a significant factor influencing market stability. From ongoing conflicts to trade tensions and shifting political alliances, these elements can act as unpredictable storms, disrupting previously established patterns and creating significant volatility. It's correct to say that nowadays we see some worldwide shifts in the global structure, and I believe that the US has to consider them and build its future development strategy according to these changes. Moreover, we must consider the ever-growing burden of US national debt. While debt plays a role in stimulating economy, activity, excessive levels can pose systemic risks. Understanding these dynamics and their potential impact on investment landscape is paramount for informed decision-making. This year, around $1 trillion will be needed to serve this debt. It's an incredible amount that cannot be ignored anymore. Compound interest can play a bad role too. It's another factor to worry about. So, what do I think about that? Today we talked about the macroeconomic, geopolitics, US national debt. I do not want to be the guy screaming about the wolves, but be careful there. Not tomorrow, and most probably not this year, but in the really near future, we may meet a severe financial storm. Considering the geopolitical situation, I would even assume that it will be harder than the global financial crisis in 2008. Prepare for volatility. Keep cash ready. Personally, I will pay attention to American companies working in the inner market. Even if some major external conflicts appear, the dollar falls hard, etc. There are 330 million people in the US. It's a huge market. Like, it's an enormous market anyway. So after the storm always comes the calm. Again, everything you hear today is not the financial advice. Do your own research and always think about risks. Again, if you did like the video, please press the like button, subscribe to the channel. See you in the next video.